Sources of corporate finance. In this topic, we will be studying about retained earnings or retained profits and the determinants affecting retained earnings.
Retained earnings are the portion of a company's net earnings that it doesn't pay out to shareholders as dividends. The company keeps this money and reinvests it in the business or uses it to pay off a portion of its debt. To see how much of its earnings a company has retained, look at the balance sheet under shareholders' equity. Retained earnings can also be reported on a separate statement called the Statement of Retained Earnings. You may also hear retained earnings referred to as the retention ratio or retained surplus. When companies reinvest their retained earnings, they're expecting to earn a return on that investment, whether they're investing in new machinery, research and development, expansion into another market, or anything else that would help the company grow or become more efficient and profitable. Increases in a company's share price or its earnings per share over time are good indicators of how effectively the company has been using its retained earnings to help the company grow. If a company is retaining its earnings, but earnings per share aren't increasing, the company isn't growing and investors will want to receive a dividend. If the company is neither improving profitability nor paying a dividend, investors may want to pass. Anything that affects a company's net income, such as a change in its expenses or revenue, will affect its retained earnings. If the company increases or decreases its dividend, this action will also affect retained earnings.
Let us now understand what is the meaning of retained profits. A company does not distribute the entire profits to the shareholders. A part of the profits is retained aside for some sudden expenses. These expenses might be in the current year or it might be for some future expenses. These reserves have to be maintained every year. According to the Companies Act, these reserves have to be maintained as per the rules given in it. This amount keeps on accumulating every year if it remains unutilized. Because if there are no expenses that the company is going to have, or rather if this amount is going to remain unutilized, then it keeps on accumulating. This amount is then got into the business if it requires capital. The process of converting these accumulated profits into capital is called capitalization of profits. This means wherein this capital is going to be got into the business. Therefore, the conversion process, that is where the profits are getting converted into capital. Usually, this capital is got into the business by way of shares. Part of net profits that is not distributed is known as reserve funds. Every year, the company has to keep aside a fund, that is the reserve fund, which is kept after paying off all the direct and indirect expenses. It is known as ploughing back of profits or self-financing. Ploughing back, this concept is got from the fields, that is wherein when a farmer ploughs his land, at that time a certain portion of the mud is thrown aside, and this is again utilized when the farmer is sowing the seeds. That is wherein the farmer does not have to get any external mud, or rather wherein we say that he uses the same mud for again ploughing the farms. Therefore, this concept has been got from there itself, wherein ploughing back of profits, that is wherein the profits that the company is earning, that itself a certain part of that profits is kept aside. And so this particular profits, that is the mud of the farmer, and wherein here we are saying the profits that is being kept aside is got back into the business. Therefore, it is called as self-financing, wherein the company does not have to depend on any external sources when it requires any capital. This use of retained profits as capital, it is known as a source of internal finance. that is, wherein the firm has got this into the business. This is a type of owned capital funds because the company does not have to return it back to anyone. It is converted into permanent capital. This is going to be utilized, or it is going to be converted into shares, and this is given to the existing equity shareholders. Therefore, it remains into the business. It is a simple and the cheapest method of financing because the company does not have to pay, rather it does not have to pay any dividend on this type of capital at present. And so this retained profits, that is wherein the company does not have to advertise, or rather where the company does not have to use any extra cost to get back this capital into the business. Determinants of retained profits. The factors that decide the amount of retained profits that has to be maintained by every company. Total earnings of the company. When the company earns more, the savings also will be more. This depends on the approach of the management. If the company decides to have more of savings, this will be depending on how much the company is earning. So the entire earnings of the company will decide the reserve fund that has to be maintained. Taxation policy, one of the most important policy of the government, that is, which is going to affect the factors of the retained profits. And so the taxation policy is more, that is wherein the company has to give more taxes, at that time it maintains less of reserves. The dividend policy. This depends on the thinking of the board of directors. If the board of directors are safety players, that is, wherein they decide to give more of dividend to its shareholders, the reserve funds will automatically decrease. But if the board of directors decide to give a moderate rate of dividend to its shareholders, that time the reserve fund will be comparatively more. So, if the board of directors are safety players, that is wherein they decide to have more of reserve fund, the dividend of the shareholders decreases. If the board of directors are risk players, they will give more of dividend to the shareholders. At that time, the reserve fund will be less. This decides the market price of the shares also. Government control. So the reserves depends on the government policies. The government is a regulatory body of the economic system. The government decides the various rules and regulations for every company. The companies have to decide the reserve funds based on the government policies. Therefore, the government policies will decide as to how much will be the reserve funds of the company. Based on that, the company has to formulate, it has to decide the dividend policy of the company.